What's up, traders? So today I had a question in my social media from a trader that is long Apple using options. And they don't want to necessarily take profit, but they wanted some way of capturing the gains that they have, especially given the technical analysis situation that it's in right now. By the way, if you want to ask these kind of questions, just look below for the links to join. I love talking about trading and helping people with what I know for free. So, if we take a look at the chart right now on Apple, it is coming up to what some might see as a potential double top. It's also getting very overbought, depending on what technical analysis instruments you look at. Now, it could go higher or it could turn around from this point. We don't know. But the trader that I was speaking to is long some October 150 calls. And this is what their P&L looks like right now. So they're doing quite well on this call option, but they don't want to give it up just yet because they've really only made about 20% on their initial risk on buying these calls. And that's really not enough. We had to pay a lot for these options. So we don't really want to take it off at the first sign of profit, especially as many days out as we have on these still far out of the money calls. So what can we do? Well, in these situations, what I like to do is take our existing calls or existing options, whatever they may be, and then hedge them by taking our single option and converting it into either a calendar spread or a diagonal spread. And we're going to talk about those both and how and why they work. What we're doing is we are taking our existing long option and we are selling another out of the money option against it with a closer dated expiration. That way, we can maintain our long dated option and then capture the theta decay as well as hedge our directional exposure with the short dated option. Let's look at the option chain, and we're going to look at Thinkorswim platform to do this. So here is the option chain as it stands right now. And our trader is long the October 15th, 2021 150 call. Has about 100 days until expiration, so there's a lot of time for us to work with on this. I like it. I like this a lot, especially since it's already in profit. What we can do from here is we can create a calendar. Now, some people like to put on calendars when they open a trade. And what they'll do is they will buy a long dated option and then they'll sell a shorter dated option with the same strike when they put it on. And that helps offset the cost of the long dated option. It's pretty good. But I like it even better when we've taken on the risk of buying the single option at whatever technical setup we want. And then later, once we've shown a profit, we sell against it because that actually creates a higher reward situation because we bought the long dated option cheaper and we're now able to sell the shorter dated one for more premium. But to each their own. Here's what we could do to make this into a calendar in the simplest way. We can go out to the 16th of July, 2021, which has 9 days left. And if we look right here, we'll see that we could sell this for about maybe 47 cents. It's not insignificant, but it doesn't really do much to offset our $5 calls for the 150s out in October. We also need to consider what catalyst do we have coming up? Well, if we look, we can see on Apple that we have earnings coming up on July the 27th. And actually, that's aftermarket. So that means that July the 28th is the key day that we want to key off of. That's important when we're looking at our potential options. So if we take the July 16th, we don't have earnings factored in there, which is neither good nor bad, depending. We don't have the potential risk of earnings, but we also don't have the increased implied volatility. Now, if we look here at implied volatility, we'll see that it's about 24%, whereas our bought option is about 25%. There's a difference. And when you're selling premium, when you're selling options, you want to go by the old adage of buy low, sell high. So ideally, what we want to do if we're going to sell an option is we want to sell it at a higher IV than we have our long option. So this doesn't really fit that criteria. If we go to the August expiration and we look at the 150 here, we'll see that we're at 26% here versus 25% on our October option. There, we're able to sell a relatively higher implied volatility against our existing long option. That's good. That's what we want to do, ideally. And the reason for that is we have earnings baked into this option. We can also get a lot more premium as a result of it being further out and that increased implied volatility. We could offset by almost half by selling about $2.84 versus our 5.10. So that is what we could do to set up a calendar. Another way is to do it using a diagonal. And I like this best because ideally we are looking to stay long the stock, long the movement of the stock. So we want to keep this directionally long. And we need to look at our delta and compare the two between our long 150 call and our potential short 150 call. If we sell this one against it, we're going to be shorting 34 delta versus our long 40 delta. We're only going to be about 6 delta long at that point. It's kind of neutral. Whereas if we were to look at our option here in July, we would be shorting 16 delta versus our 40. So we'd still be long 24 delta. So we'd still have a much better long bias in this case. We should also consider theta. The theta decay of the shorter dated is about 7 cents a day versus the 4 cents a day on our long option here. So if we took this one, we would get a much faster theta decay. Whereas if we took the August, it's 5 cents versus 4 cents, still positive theta, still good. But the further we go and the closer we are to the same strike, we basically created a neutral play. We're no longer very long the stock, and we're not really capturing much theta decay for ourselves. We're offsetting, basically just going neutral at this point, which is fine if that's what the trader wanted to do. But we still want to stay long the stock. So what we could do is this. Instead of doing a calendar, we could sell an option one strike above our long option. So we could sell the 155. And that changes the equation. So now we're still, instead of short 34, we're now short 23 delta, which lets us still be long the stock. And we're basically offsetting theta to zero. This means that we're not really going to theoretically lose money over time, and we can still capture some potential upside. So I'm using the risk graph here now to show what this looks like. So if we take a look at the options, I went ahead and put in what this trader's starting price was, which was $4.88 that he purchased this for. And at this point, we could sell the August expiration 155 for about 170. If we're looking at this today, what these lines are in the risk graph, the blue line is our at expiration profit and loss line, and the purple line is the today, the day that I select down here. So if for some reason Apple were to drop immediately to 140 and we have this play on, the trade itself is only going to lose $124. What if we were to take off that sell? What if we didn't do the sell? Well, if that happened, we would lose almost $350. So it's almost a 2-to-1 or 3-to-1. Whereas if we were to go up to 150, we would capture about 376 in profit, versus if we didn't do it, we might capture about 916. So we basically changed the volatility of this trade so that we're going to lose less and potentially make less, but it's not going to swing nearly as wildly because it's hedged. Let's go out a week and see what happens. Just a week and see if maybe we break this high, what's going to happen. Well, at this point, our risk is basically the same. But if we hadn't put on that hedge, it would actually be much more that we would be losing because of time decay and the increased delta. Our profit, 837 versus having it on 423. It actually gets better. We are limiting our profits, but not as much. We're still capping that downside at about the same, about a third of what it would be with a single option. And now we're only giving up about half of our potential profits. Now, bear in mind, we can still have this August expiration expire. And let's see what happens if we go out to that week before expiration. If we are at 150, we are up 832. But as soon as that option expires, if it expires worthless, we are now able to capture that full value. It's no longer working against us at that point. And that's where the real beauty of it comes in, is when we've expired that option. So another thing we can consider is if we do this, if we sell the August and we are able to capture all of that premium, now we are 44 days ahead. We still have our October option at whatever price it may be, but we have another expiration cycle, the September, that we could still even sell against it. We could offset the cost even more, or we could almost make it a completely free trade depending on where the premium sits there, a zero risk trade by doing something like this. The risk in this case is that we cap our profits, but we've offset the potential of a technical analysis breakdown of the stock. So I hope this helps. If you're long options and you're looking for ways to either take profit or hedge your exposure, if you get to a point on the chart that you are feeling nervous about, if you have questions like this, make sure you join social media. And if this helped, make sure you like and share and subscribe and all those good algorithmic things. Trade wisely, and we'll see you in the next video.